Hi guys, and welcome back to Economics. This week I sold one of my positions. That's right, a stock I held for just 5 months, it's now gone from my portfolio. It underperformed the S&P 500 and its latest earnings report was not convincing. Take a look at my portfolio, I only hold 7 stocks, a mix of long-term investments and a few speculative bets. Some, like Google, are performing beautifully. Others, not so much. Which one do you think got killed, sold, eliminated? The company I sold is Yeti. Even if they are going viral on TikTok with their new bag, I see a critical problem in their situation. In a minute, I will break down the reason I decided to sell, even when American moms love Yeti Camino.
Do I love it? Yes, I do. So, I'm a bog bag girly.
But that's not all we are covering today. The market is full with news. First, Warren Buffett's Berkshire Hathaway just bought a stake in UnitedHealth, sending the entire healthcare insurance sector up on Friday. But did they pick up the best company or just the biggest? We'll talk about this move. Then we will look at the real healthcare disruptor, HIMS and hers. The stock is getting hammered. Investors are spooked by rumors of a lawsuit from Novo Nordisk and HIMS CEO selling 33 million in shares. Is this stock sinking or it's a golden buying opportunity? Is it too risky? We'll also check on the smallest and perhaps the most exciting stock in my portfolio. Yeah, Sanara Medtech. It just reported earnings and the stock shoot up 15% before pulling back. I believe it's deeply undervalued and I will show you why. And finally, we are changing topic to discuss an asset that got rejected from its all-time high, Ethereum. Is the crypto euphoria back or is it just a trap? I will share my simple contrarian strategy. So, we have a lot to get through. Let's start with why I broke up with Yeti. To understand this decision, you need to know a little bit about my investing style. Unlike Joseph Carson that, he only focused on great companies, compounders, that's not my style. My goal is to find great deals. I search for stocks that are cheap, oversold, hated by the market, companies where the price has become disconnected from their fundamental value. For me, almost any stock could be a bargain only if the price is right. It doesn't have to have a huge moat or being a great company. And that brings us to Yeti. During 2024, Yeti was going down. By March 25, the stock was down almost 40% from its high, even though its revenue and its profit were stable. It looked like a consistent value play. My timing, however, was terrible. I bought it on April 1st, right here, before Trump's tariffs announcement sent the stock down another 20% within a week. Bummer. I was down, but I didn't panic sell. Instead, I went back to the data. Yeti was and still is a company producing around 185 million of free cash flow. Actually more, but I always exclude share-based compensation. And was trading at a market cap of 2.2 billion. That's a 12 times price to free cash flow. Even with little growth, there was no reason to take a loss while I was still convinced the company will eventually bounce back. And that's what happened. In June, one of their bags went viral and the share price really moved. Even Chris Camillo called it out.
And now, the Camino bag by Yeti has become the mom bag of the summer.
I was happy, I was hoping for great earnings or at least great forward guidance. It was a known fact that the bags were sold out, but I was still thinking they would restock quickly and improve their guidance. Instead, they missed top-line revenue by 20 million, net sales decreased 4%, and gave a quite depressed outlook for the coming months with flat guidance. Over the 5 months I held the stock, I realized something crucial I initially underestimated about Yeti. They have no moat whatsoever. And for my valuation system, no moat means higher risks. Originally, I've assigned Yeti a risk score of 37 out of 100, which gave me a fair value of $55 per share. If we check Yeti during the last years, I think they deserve some trust. For example, For a small cap company, they did a great job from 2007 to lower their debts. This is a great sign of a good management. They increased their cash position, another great sign. Not only they did improve the balance sheet, they even found the cash to buy back shares, lowering the share count from 88 million to 83 million. And these are very positive signals and a reason I initially gave a medium-low risk score of 37, but lately I'm realizing how much riskier businesses are without a strong moat. After re-evaluating their lack of competitive advantage, I had to adjust the risk score to 54. Do you know what it did to my valuation? It dropped the fair value to just $40 per share. This single change turned a bargain into a stock that was just slightly undervalued. My margin of safety is gone, and with the current macro uncertainty, I sold all my shares at 35, banking a small $500 profit. It was not much, but hey, with this money my wife can finally get a new dishwasher. Check it out, the old one, it doesn't wash. Even with a 5% gain, I technically lost. During the same period, the S&P 500 was up nearly 14-15%. And this was a painful reminder to always evaluate risk very carefully. I will try to do better in the future. Next, let's talk about Warren Buffett buying UNH. As I said before in this video, the healthcare insurance sector is filled with bargains right now, but is UnitedHealth the best one? The value investor community is clearly excited by this news, and people that bought UNH recently thinks like they are the next Warren Buffett. Personally, I don't even think it's Warren anymore making this decision. Even if in theory he's still CEO till the end of the year, he's 94. Probably Greg Abel taking this decision already, consulting with Warren, of course. Anyway, this is not important. I want to know, I ask myself, if UNH is currently the best deal the insurance sector is offering. If we look at the most simple metric, the forward P ratio, UNH is trading at 18, was 16 before the announcement. Meanwhile, competitor like Centene at 13, Elevance, it's under 10, Molina, it's at 9. So why would Berkshire buy UNH? Honestly, I don't think it's the best deal overall, but it's the only one big enough for them. Berkshire is sitting on 350 billion in cash. If they were to invest in a smaller, cheaper company, let's say my pick, Oscar Health, with a market cap under 4 billion, let's consider that regulation often limits ownership at 10%, so with a 400 million investment in Oscar, they would buy 10% but wouldn't make any difference in their balance sheet. My belief is that the whole sector is currently undervalued. UNH is not the best deal, in my opinion, but it's the only one that's big enough for Berkshire to make a small difference in their huge cash position. Anyway, Berkshire investment is a massive validation for value investors that entered the space before this news. For me personally, it's a sign that my indicator works. I made this video talking about how the value ratio for this sector was very low, how they were very good bargains, and 2 weeks later, the greatest investor of all time is buying the biggest UNH, the biggest stock in the sector. It can't be random. I'm considering adding some Centene or Molina. Now, HIMS and nerds, the stock is selling off hard, but before we buy, we need to talk about the two bad news we got lately. Are they real threats or not? Personally, I would like to enter this company again because HIMS was my best deal I made this year. I just bought at 25.39 on April 4th and sold at 62.38 just 40 days later. Since then, the stock has been on a roller coaster. Now it's at $46, 25% lower than my selling price. So I'm thinking of buying back in. There are two reasons why HIMS is selling off. First of all, the concern I always had about Novo Nordisk suing them are actually materializing. If HIMS sold compounded GLP-1 to patients without allergies or other special needs, they are breaking the law. I have no idea if HIMS have done something illegal or not, but would you really be surprised if they did? I mean, I wouldn't. HIMS is a disruptor. It's not crazy to think they're bending the rules on their favor. A lawsuit at this point is probable, in my opinion. Novo has filed more than 130 cases in 40 US states this year alone. In my opinion, if Novo decide to sue, they have higher chances to win in court with the FDA support and the concern for public safety. On top of that, HIMS CEO is selling 33 million of his shares. This doesn't transmit confidence to retail investors like us. It's not something to panic sell your share over, but it's not an encouraging sign either. I do wonder, maybe he knows they did something illegal and the FDA is going to punish them, so he's selling now? Anyway, I don't think a penalty will put HIMS out of business at this point, so actually it might be a very good opportunity to open a position. Let's see if investor will panic sell the bad news. I'm looking for a good entry price, and I would probably buy if the shares goes back to this trend line or lower. Let me quickly show you the value ratio for HIMS. With a 26% growth and a 52 risk, I get $55 fair value. Now, let's quick check on another stock in my portfolio, Sanara Medtech. I have $21,000 in this small unknown wound care company. So why such a big bet in a so tiny company? The reason is simple. For me, it all comes down to some very compelling numbers. Check this out. Sanara core business is growing at 25-30% year over year and is on a verge of incredible profitability with a 90% gross margins. Based on their last quarter results, Sanara surgical segment generated 4.7 million of adjusted EBITDA, and based on this, the stock is trading at a forward PE of around 14. And that's a steal for this level of growth. The reason they are not already GAAP profitable is that in the last few years they invested a considerable amount into a telehealth platform called THP. I just like it because it reminds me of one of the most relaxed molecules ever, the THC. Anyway, in the last earnings call, they claim they want to stop investing big capital on this segment and will look into partnerships. Let's see if they can monetize this side project, but even if they can't, their core business is very undervalued. I believe the potential reward is massive. With 20% growth and 39 risk score, I get a fair value of $46. I don't expect it to stay at this low price for long, but I also don't plan to increase my already substantial position in Sanara. Finally, let's talk about something other than stocks. This week, Ethereum deserved to be mentioned since it got rejected from its all-time high. So, what should I do? If you're not familiar with crypto, Ethereum is the second largest crypto by market cap. Apart from Bitcoin, is the only other crypto that can be traded with an ETF. The problem of value investors with crypto is that we can't calculate fair value. It's a currency, so there is no earnings, there is no cash flow. So how do I decide when to buy or sell when there are no fundamentals to analyze? Personally, I rely on the one thing I do the best, my natural talent, being a contrarian. It's very simple. When sentiment is euphoric and everybody is happy and bragging, I sell. When the mood is depressed and everybody is predicting crypto death, I buy. Right now we are somewhere in the middle. There is excitement, but we are not at peak FOMO. So for now, I'm holding my position and waiting patiently for the market to go crazy. I believe Ethereum will see new all-time high and the sentiment will change. I hope you enjoyed this video. I'm still experimenting with very different YouTube formats to see what kind of video you liked best, so please let me know. If you want to see another video in a complete different style, last week I evaluate Google and explain why I think the stock will go to $300. It's a very fast-paced video, 7 minutes only. You can watch it here. Thank you for watching Under Economics. Consider subscribing, leave a like. See you next week. Peace out.